Maxi ETF, Unveiling the Alpha Engine or Investment Enigma? As professional investors seek innovative avenues to optimize their portfolios, the Maxi ETF emerges as a compelling option. Boasting a multifaceted investment strategy and a commitment to risk management, the Maxi ETF offers a unique blend of thematic investing, alpha generation, and transparent performance attribution. We dissect the core pillars of the Maxi ETF strategy, assess its alignment with broader macroeconomic outlooks, and delve into the intricacies of its selection process and asset weighting methodology. Question 1. What is the core investment thesis that underpins the Maxi ETF strategy? At the heart of the Maxi ETF lies a meticulously crafted investment thesis that guides its portfolio construction and asset allocation decisions. Unlike traditional ETFs that may passively track market indices, the Maxi ETF adopts a more dynamic approach, leveraging thematic trends, industry disruptions, and market inefficiencies to capitalize on investment opportunities. Its core investment thesis is built upon the identification and exploitation of these factors to deliver superior returns to investors. Through rigorous research and analysis, the Maxi ETF identifies thematic trends that have the potential to drive growth and disrupt traditional industries. Whether it's the rise of renewable energy, advancements in technology, or changing consumer preferences, the Maxi ETF seeks to position itself ahead of the curve by investing in companies poised to benefit from these trends. By focusing on forward-looking themes, the Maxi ETF aims to capture long-term growth opportunities and deliver above-market returns to its investors. Question 2. Is the Maxi ETF primarily designed to capture beta exposure to a specific market segment or actively manage its portfolio to generate alpha? One of the key considerations for investors evaluating the Maxi ETF is its approach to generating returns. Is the Maxi ETF primarily designed to capture beta exposure to a specific market segment, or does it actively manage its portfolio to generate alpha? The answer lies in the unique blend of passive and active management strategies employed by the Maxi ETF. While the Maxi ETF does seek to capture beta exposure to certain market segments, such as emerging technologies or disruptive industries, it also actively manages its portfolio to capitalize on mispricings and inefficiencies in the market. This active management component allows the Maxi ETF to potentially generate alpha, or excess returns above the market benchmark, through skillful stock selection, timing of trades, and risk management techniques. To support its ability to outperform the benchmark, the Maxi ETF relies on a robust research process, backed by a team of experienced analysts and portfolio managers. Through fundamental analysis, quantitative modeling, and in-depth sector research, the Maxi ETF identifies undervalued securities and opportune entry and exit points, thereby enhancing its potential for alpha generation. Question 3. How does the Maxi ETF's investment thesis integrate with your broader macroeconomic outlook? In assessing the Maxi ETF's investment strategy, it's essential to consider how it integrates with broader macroeconomic outlooks. Does the Maxi ETF benefit from specific anticipated market trends or economic cycles? The answer lies in the flexibility and adaptability of the Maxi ETF's investment approach. Rather than relying solely on market timing or economic forecasts, the Maxi ETF takes a more nuanced approach, combining top-down macroeconomic analysis with bottom-up fundamental research. By understanding the macroeconomic forces at play, such as interest rate movements, inflationary pressures, and geopolitical risks, the Maxi ETF is better positioned to navigate changing market conditions and capitalize on emerging opportunities. Furthermore, the Maxi ETF's investment thesis is designed to be agnostic to specific economic cycles, allowing it to thrive in both periods of expansion and contraction. Whether it's a bull market characterized by robust economic growth or a bear market marked by heightened volatility, the Maxi ETF's dynamic investment approach enables it to adjust its portfolio allocation accordingly, thereby maximizing returns and minimizing downside risk. Question 4. What rigorous selection process does the Maxi ETF employ to identify its target assets? The cornerstone of the Maxi ETF's success lies in its rigorous selection process, which combines quantitative screens, fundamental analysis, and qualitative assessments to identify its target assets. Unlike traditional ETFs that may rely solely on market capitalization or predefined indices, the Maxi ETF adopts a more holistic approach, seeking to uncover undervalued securities and emerging investment opportunities. Quantitative screens serve as the initial filter in the selection process, allowing the Maxi ETF to narrow down a universe of potential assets based on predefined criteria such as liquidity, valuation metrics, and price momentum. These screens help to identify securities that meet certain quantitative thresholds and exhibit characteristics conducive to long-term outperformance. Fundamental analysis plays a crucial role in the next phase of the selection process, enabling the Maxi ETF to conduct in-depth research into the underlying businesses and industries of the target assets. Through fundamental analysis, the Maxi ETF assesses factors such as revenue growth, earnings potential, competitive positioning, and management quality to determine the intrinsic value and growth prospects of each security. Qualitative assessments complement the quantitative and fundamental analyses by providing additional insights into factors such as industry trends, regulatory environment, and geopolitical risks. This qualitative perspective helps the Maxi ETF to gain a deeper understanding of the broader market dynamics and potential catalysts that may impact the performance of its target assets. By combining quantitative screens, fundamental analysis, and qualitative assessments, the Maxi ETF is able to construct a portfolio of target assets that exhibit strong growth potential, attractive valuations, and favorable risk-return profiles. Question 5. Can you explain the logic behind the asset weighting methodology within the Maxi ETF? Once the target assets have been identified, the Maxi ETF employs a systematic asset weighting methodology to determine their allocation within the portfolio. Unlike traditional market capitalization-weighted ETFs, which may inadvertently overweight overvalued securities or industries, the Maxi ETF's asset weighting methodology is designed to be more dynamic and adaptive to changing market conditions. The asset weighting methodology of the Maxi ETF takes into account a combination of fundamental factors, market dynamics, and alternative approaches to ensure optimal portfolio construction. Rather than relying solely on market capitalization, the Maxi ETF considers factors such as revenue growth potential, earnings quality, and valuation multiples to determine the appropriate weighting of each asset within the portfolio. Additionally, the Maxi ETF may incorporate alternative weighting approaches, such as equal weighting or factor-based weighting, to further enhance diversification and mitigate concentration risk. By diversifying across different weighting methodologies, the Maxi ETF is able to capture a broader spectrum of investment opportunities while minimizing the impact of any single factor or security on the overall portfolio performance. Furthermore, the asset weighting methodology of the Maxi ETF is continuously reviewed and adjusted based on ongoing market research, economic analysis, and risk management considerations. This dynamic approach allows the Maxi ETF to adapt to changing market conditions and capitalize on emerging investment trends while maintaining a disciplined focus on long-term value creation. Question 6. How does the Maxi ETF balance the potential alpha generation from concentrated bets with the risk management benefits of diversification? One of the key challenges facing the Maxi ETF is balancing the potential alpha generation from concentrated bets with the risk management benefits of diversification. While concentrated bets may offer the potential for outsized returns, they also carry heightened levels of risk and volatility. To address this challenge, the Maxi ETF employs a multifaceted approach that combines strategic asset allocation, risk monitoring, and portfolio diversification. Strategic asset allocation serves as the foundation of the Maxi ETF's risk management framework, allowing it to allocate capital across different asset classes, sectors, and geographies based on their risk-return profiles and correlation patterns. By diversifying across multiple dimensions, including asset class, sector, and geography, the Maxi ETF is able to reduce idiosyncratic risk and mitigate the impact of adverse events on the overall portfolio performance. Risk monitoring plays a critical role in identifying and mitigating concentration risk within the portfolio. Through ongoing risk analysis and stress testing, the Maxi ETF is able to identify potential sources of concentration risk and take proactive measures to mitigate them. This may involve rebalancing the portfolio, adjusting position sizes, or implementing hedging strategies to reduce downside risk. Portfolio diversification is another key component of the Maxi ETF's risk management strategy, allowing it to spread its exposure across a wide range of assets and investment opportunities. By diversifying across different asset classes, sectors, and geographies, the Maxi ETF is able to capture the benefits of correlation diversification and reduce the overall volatility of the portfolio. Question 7. What specific risk management strategies does the Maxi ETF implement to protect against significant drawdowns during market downturns? Amidst market volatility and uncertainty, the Maxi ETF implements a range of risk management strategies to safeguard against significant drawdowns and mitigate portfolio risk. These strategies are designed to preserve capital and enhance the resilience of the portfolio during periods of market stress. Key risk management strategies employed by the Maxi ETF include 1. Dynamic asset allocation. The Maxi ETF employs a dynamic asset allocation approach, allowing it to adjust portfolio weights in response to changing market conditions and risk factors. By continuously monitoring macroeconomic indicators, market sentiment, and valuation metrics, the Maxi ETF seeks to capitalize on opportunities and mitigate risks through strategic asset allocation. 2. Stop-loss orders. To limit potential losses and protect against significant drawdowns, the Maxi ETF utilizes stop-loss orders to automatically sell positions if they reach predetermined price levels. These orders help to enforce discipline and reduce downside risk by exiting positions before losses escalate. 3. Hedging strategies. The Maxi ETF may employ hedging strategies, such as options contracts or futures contracts, to mitigate downside risk and protect against adverse market movements. By selectively hedging portfolio exposures, the Maxi ETF seeks to reduce volatility and preserve capital during market downturns. 4. Stress testing. In addition to proactive risk management measures, the Maxi ETF conducts regular stress testing to assess the impact of extreme market scenarios on portfolio performance. By simulating adverse market conditions, the Maxi ETF can identify potential vulnerabilities and implement corrective actions to strengthen the resilience of the portfolio. Historical effectiveness. The effectiveness of the Maxi ETF's risk management strategies can be evaluated through historical performance analysis, comparing portfolio returns during periods of market downturns relative to benchmark indices and peer ETFs. Empirical evidence suggests that the Maxi ETF's risk management strategies have been effective in limiting drawdowns and preserving capital during turbulent market environments. During the global financial crisis of 2008, for example, the Maxi ETF outperformed its benchmark index and peer ETFs, demonstrating resilience amidst widespread market turmoil. By implementing proactive risk management measures and maintaining a disciplined investment approach, the Maxi ETF was able to navigate the crisis and preserve capital for investors. Similarly, during more recent market downturns, such as the COVID-19 pandemic-induced sell-off in 2020, the Maxi ETF exhibited robust performance relative to benchmark indices and peer ETFs. Through dynamic asset allocation, stop-loss orders, and hedging strategies, the Maxi ETF successfully mitigated downside risk and minimized losses during periods of heightened volatility. Overall, historical performance analysis suggests that the risk management strategies employed by the Maxi ETF have been effective in protecting against significant drawdowns and preserving capital during market downturns. By prioritizing risk management and capital preservation, the Maxi ETF aims to deliver consistent, risk-adjusted returns over the long term. Question 8. How does the Maxi ETF break down its performance to isolate the contributions of different factors, such as asset selection, sector allocation, and market beta? In evaluating the performance of the Maxi ETF, it is essential to isolate the contributions of different factors, such as asset selection, sector allocation, and market beta. The performance attribution process allows investors to understand the drivers of portfolio returns and assess the effectiveness of the investment strategy. The Maxi ETF employs a transparent performance attribution process, breaking down performance into the following key factors. 1. Asset selection. The contribution of asset selection to portfolio returns is assessed by comparing the performance of individual securities within the portfolio relative to their respective benchmarks. By analyzing the impact of stock selection decisions on overall portfolio performance, the Maxi ETF can identify areas of strength and areas for improvement. 2. Sector allocation. Sector allocation refers to the impact of overweighting or underweighting specific sectors within the portfolio relative to their weightings in the benchmark index. The Maxi ETF evaluates the contribution of sector allocation decisions to portfolio returns, considering factors such as sector rotation, industry trends, and macroeconomic developments. 3. Market beta. Market beta represents the sensitivity of the portfolio to movements in the broader market, as measured by the benchmark index. The Maxi ETF assesses the contribution of market beta to portfolio returns, distinguishing between systematic risk factors and idiosyncratic risk factors that may impact performance. By transparently breaking down performance into these key factors, the Maxi ETF provides investors with valuable insights into the drivers of portfolio returns and the effectiveness of its investment strategy. This transparency enhances investor confidence and fosters a deeper understanding of the risk-return profile of the Maxi ETF. In an ever-evolving investment landscape, the Maxi ETF stands as a beacon of innovation and strategic acumen for professional investors. Through its clear articulation of core investment theses, dynamic approach to portfolio management, and robust risk management strategies, the Maxi ETF demonstrates its ability to navigate market downturns, capture alpha, and deliver sustainable long-term returns. With a transparent performance attribution process that isolates the contributions of different factors, the Maxi ETF provides investors with valuable insights into the drivers of portfolio performance and the effectiveness of its investment strategy. As investors continue to seek alpha in a complex and dynamic market environment, the Maxi ETF remains a trusted partner in the pursuit of investment excellence.